Okay, so we're gonna learn about the content and the format of the statement of cash flows. Okay, so when we are reporting the cash flows, right? Cash flows are really important, right? So what is cash flow like? So I always use a um, parable, right? So if you think about an animal, right, like a being, a living being, right? No matter how big the size of the being is, it could be an elephant or it could be like a sparrow, right, like a bird, little bird, right? What's the most important thing for them is the blood circling, right? So only when the blood is flowing, right, the animal can live, right? The bird can live. Without that blood flow, right? No matter how the size of the being, right, is dead, right? So the same idea for the cash flow, right? Cash flow is kind of like the blood for the corporation, right? So some corporations can be worth of billions of dollars, right? Other companies maybe they only have an asset of like $1 million, right? So some companies they have more assets than others, so maybe the size is larger, right? But regardless how big the size of the corporation, it's really important the corporation have sufficient cash flow, right, to make sure the corporation, the operations is ongoing, right? So therefore, it's really important for the managers, the CEO, the CFO of the corporation, to have a sense of how the cash flow is generated. So where the cash are generated and how the cash is used, right? Only when the executives have a better idea about the generation and the usage of cash flow, then they can be better prepared, right? If there is a shortage of cash flow, then the CFO, the executives should be prepared earlier to borrow money from the bank. Okay, if there's more cash than necessary, you don't want to have too much unused cash sitting on your bank account, right? So a better way to use it probably would be to use the cash to repay some of your loan, right? So to save you some interest expense, right? So therefore, it's really important you have sufficient cash balance, not too much, not too little, right? To make sure that the corporation is running in a healthy cycle, right? So therefore, reporting cash flow is really important. Okay, so there are two different methods to do it. The indirect method, okay, so that's one method, versus direct method. Okay, so there are two type of method to prepare cash flows. So indirect method versus direct method. So under when you use the indirect method, okay, so basically you prepare the activities into three different sections. The first section is called operating activity. Okay. The second is called investing activity. And the last one is called financing activity. Okay. So that is the three activity sections. So normally, when you think about operating activity, so what is this section about? This section is really about current assets and current liabilities. So if you think about the items on the statement of financial position, right? There are current asset, long-term asset, current liability, right? Non-current liability plus equity. So if you think about operating activity, it's really relevant is the current assets and the current liabilities. And investing activity, this is about non-current assets. When you buy a building, when you sell a vehicle, right? You are going to either when you buy a building, you're going to use cash, right? Um, so that will be a cash outflow under investing activity. If you sell a vehicle, when you sell a vehicle, you are going to receive cash, right? So in that case, that's going to be a cash inflow, okay, under the investing activity. And last, in this section, financing activity, that deals with how you're gonna raise your capital, right? You can raise your capital through long-term debt, so non-current liabilities, and you can also raise your capital, right, through issuing common shares, right? So that is the equity. Okay, so basically, operating activity section. So the related items are current assets and the current liability. For investing activity section, it is about non-current asset. And for financing activity, that's about non-current liability and equity. So that would cover the three activity section. Okay. We could use cash flow to evaluate a company. Companies with stronger cash flow, right, probably will be evaluated at a higher price. So what's the purpose for of the statement of cash flow? It's going to help the user. Right? The purpose of this information is to help the user. It's going to help user to assess a company's ability to generate cash from its operating activity, how the company received and used other cash flows regarding investment and financing activity. So operating activity is the cash, right? Think about the cash flows related to running the business, right? How many cash you have received from the operations? How many cash you have spent for the operations, right? And those are the cash flow from the operating activities. And then how the company receive and use other cash flows regarding investing and financing activity, right? For growing companies, they will investing into the non-current asset. They will buy land, build the buildings, right? Maybe even like have patents, right? Those kind of things. Are you buying a land or you are selling a land, right? So this is all either you buy a land, it's gonna use some cash. If you sell a land, you're gonna receive cash. So this will be related to the investing activity. Financing activity, did you pay dividend, right? Did you issue new shares, right? If you issued 3,000 shares for $1 million, you receive $1 million cash, right? So that would be a cash generated under the financing activity. Okay. So once we have the statement of cash flows, a user is able to look at the information and have an idea about how the cash are generated, how the cash are used, and how much for each different activities. The information will also be useful for prediction purpose, right? because with that information of cash flow, you're able to determine the company's ability to generate future cash flows. Right? You have a current year's information. Well, that will be a base for us to make predictions about next year's cash flow. And you can make comparisons with other company, right? When you are trying to make a decision which company to make an investment, right? You can compare the two companies, right, to see which companies have a better cash flow position. Definition of cash, classification of cash flows. Cash is not just the paper bill, right? It's not just cash per se. It also include the cash equivalents. So what are cash equivalents? Short-term, highly liquid investment. Let's say you have a 90 days treasury bill, right? If you purchased a 90 days treasury bill, right? So 90 days, that's within the 3 months, right? That's considered to be a short period of time. And once the due date is up, right? Once after the 90 days, you convert that bill to cash, right? So this cash equivalent are highly liquid. Okay, they can be easily converted to cash within a relatively short period of time. And you are going to classify the cash receipts and the cash payment into 3 categories. Operating activities, as I mentioned, this is related to current asset and current liability. Investment activity, this is non-current asset. Financing activity, this is related to non-current liability and equity. So operating activity. Operating activities related to company's principal income producing activities. Principal income producing activity. If you think about the real Canadian superstore, right? So this is a grocery company, right? So their business activity is to sell the groceries, right? So in that case, their principal income producing activity is to the resale, right? It's a resale. For a car dealership, their principal income producing activities is to car sale, right? So activities relate to cash effects of transactions that create revenues and expenses that enter into determination of net income. Okay, the activities relate to cash effects of transactions that create revenue, right? So those are operation expenses. Those are operation, right? And the difference of that would be your net income. Okay, so operating activities is related to the net income. It includes relevant non-cash current assets and current liability on the statement of financial position, where the related account is a statement of income account. Okay, so as I mentioned, okay, it's related to net income, which is income statement, right? It's also related to the statement of financial position, particularly current asset and current liability. So it's 3 aspects, right? So first, net income. Second, is the current asset, and third is current liability. So these three are going to affect your cash flow from operating activity. Investing activities. So this is related to the acquisition and disposal of non-current asset. Non-current asset. So for example, you are purchasing and disposing a long-lived asset, and you have an investment not held for trading. So it's a non-current investment. You want to hold it for a long time, not just for quick trading. Okay. Lending money and collecting the loan, right? So this is your investment as well. So the point of that is you are investing to collecting interest income, right? So generally, it includes non-current asset. On the statement of financial position. Okay, so just the non-current asset on the statement of financial position. On financing activity, right? Financing activity related to the changes in a company's debt and equity. So this including you you want to raise capital by issuing debt. Okay, you want to repaying the amount borrowed, right? So either you issue debt, you receive the money, right? That's a cash inflow. But when you think I want to pay off the debt, so you use your money to pay off the debt, that's a cash outflow. Okay. Or you can deal with this is we talk about that. You can selling your shares. Okay. When you're selling your shares, you receive cash, right? Okay. And then when you're paying the dividend, right, you are giving out the cash to the shareholders, right? So you can see that these activities are related to long-term liability, the debt, and also shareholders' equity. Okay. So does this make sense so far? Okay. So far I have introduced the main structure of the financial statement of cash flow. Does this make sense? Does anyone have any question about this? About the three different types of activities: operating, investing, and financing activities. Anyone have any question on this? Okay. So significant non-cash activity. Okay. So if there is activity does not affect cash, you should not report in the statement of cash flow, right? The activities that will affect cash increase or cash decrease, those are the events should show up in that statement of cash flow, right? But if that event does not have any effect on cash, that should not be reported in the statement of cash flow. So for example, you issue a share to purchase asset or to reduce liability. Okay, what's this journal entry? Think about this. You issue shares to purchase assets or to reduce liability. What is the journal entry? So I need someone tell me what is the journal entry when you issue shares to purchase assets or to reduce liability. What is that journal entry? You don't have to tell me the number, just tell me the accounts and the debit or credit. Let's see. I have one student telling me debit asset, credit equity shares. Okay, good job, Comrade. So one way to go is you debit asset because you are purchasing the asset, and you issue the shares, you credit the shares. This is when you purchase asset. If you reduce liability, you are going to debit liabilities. Okay. So I have a question for you. When you take a look at this journal entry, will the cash balance increase or decrease, or no change? So you take a look at this journal entry, you debit asset, which is the long-term equipment, right? Or you debit liability, and then you credit shares, right? In this journal entry, your cash position will increase, decrease, or remain the same. No change. Thank you. Yeah, no change. So if the cash, no change, right? Then you do not report it. So like this event, you should not report it, right? Because it's not affecting your cash. Conversion of debt into equity, right? So basically, your debt will decrease, your equity will increase. Again, you debit debt, you credit equity, right? So there's no cash effect. Exchange of PPE. Let's say I exchange a land for a building or for a vehicle, right? In that exchange journal entry, there's no cash. So there's no cash effect, therefore should not be reported for the statement of cash flows. Okay, so let's take a look at this one example here. So the format is the name of the company, and the second line is the title of the statement of cash flow. And the last one is the period covered, like for the year ended December 31st, 2024, right? And then you can see that the format, you have the three different types of activities, right? You have operating activities, okay? You have investing activity, you have financing activity, and under operating activity, you're going to receive cash. So what's the cash receipts from operating activity? And what's the cash payment? For the investing, what is the net cash provided by the investing activity? And under financing activity, what is the net cash provided or used by financial activity? You add them up, you pull all the cashes from the three activities. That is your net increase or decrease in cash. And then you know your beginning balance of cash, right? And then you consider the net increase or decrease during that period. You should have an ending balance for the cash. So basically, the statement of cash flow will explain your changes in the cash position. If it's increased, okay, you would have a positive cash flow. If it's a negative, decreased, your cash flow will be negative. Does this make sense? Does this format make sense to you? Okay, thank you, Operate. So you could prepare your statement of cash flow using either indirect method or direct method. They are different approach, okay, different approach. The main difference is on the operating activity. So the investing activity, financing activity are the same under both method. The only difference is about how they figured out the cash flows for operating activities. So indirect method will rely on net income. Okay, so they start with the net income number, and then they consider the working capital, right? Like a current asset, they consider current liability. Okay, they will make adjustment. Some items are not have no effect on the cash, so therefore, it should be taken out of the net income number. Okay, so the steps would be you first prepare operating activity. Okay, you prepare operating activity section. Second, you prepare a investing activity section. Step 3, prepare financing activity section. And step 4, you complete the statement of cash flows. So you go from top to the bottom. So you have to strictly follow that order, right? Operating, investing, and the financing. You have to strictly follow this order. It's not like you can prepare a statement in random order. Okay. So you follow these steps from the top to the bottom. Okay, so does anyone have any question about this section?